Welcome back to the Williams Real Estate channel. I'm your host, Geordie Williams. Today we are discussing established properties and why we only buy established properties when building our portfolios. Firstly, established properties can be secured well under market value and well under the rebuild costs, as when people go to sell a property, they don't necessarily always calculate in their minds what it would cost to replace it or what's its intrinsic value in the current market. They may have bought it 30, 40 years ago. You know, you hear the stories and you see the sales data of some of these properties we buy that sold for 50 grand, 80 grand, 30 to 50 years ago. So they may have bought it, paid it off over time, sitting on an unencumbered asset, and they don't necessarily, the vendor, that is, calculate how much it would cost to build the same house or unit or block of units in the current market. So when they don't do that, then they're pretty much selling for under the intrinsic value. So you can buy deals well under replacement costs, well under the intrinsic value, with strong yields from day one. So you can buy property with fat in the deal from day one. For example, this house here on the screen, we can find deals like this for 300 to 400,000. These days it costs 800-900 million bucks to build a house minimum. The cost of labor, the cost of materials, the cost of land is high to the point where the replacement costs can be used as well as when new stock is released to the market. So when people go and buy a vacant block of land, build a new house for $1 million in the same town or the suburb or the metro city, they're creating new stock and putting it onto the market. So they create the new benchmark of what fair value is based off of comparable sales. So you'll find that as new stock is released to the market, it sets the new benchmark of what fair value is, being the replacement cost, and then the established stock continues to keep rising up and up and up to that same level once people see value. So that's a major powerful thing, is you can buy property that's established that has equity from day one, anywhere between 30 to 50, 80 grand under the CoreLogic valuations we pick up, and well under, I would say, between 100 to 200,000, even 300,000, less than the median price point of the suburbs we can source deals, because it is all established and the established stock lags behind the new stock that is released onto the market. Positive geared relatively quickly. We're finding deals between 6 to a high 7%. But recently purchased a 2-bedroom unit in a metro market, an established block that was already rented out with a great long-term tenant, very clean, tidy unit that was providing a 7.8% rental yield. So even with today's rates of 6%, you can get in the fives now. We are finding deals that are still neutral to positive geared because it's established with strong yields. Equity can be accessible on purchase or within 6, 12, 18 months, depending how hard you want to go, because we buy property well under market. So then you're building your equity in from day one. So then you can refinance the loan up to the fair value to extract your capital back out plus more to then roll it into the next deal. And that's how you can use the equity release strategy to not only reinvest, but you can tap into it as you build a portfolio out as you'll find, after 5 to 6, 7 years of solid investing, property continues to go up 7 to 8% per year on average. In the booms, 20%, in the slowdowns, 3 to 4%. So you can bank on 7 to 8% capital growth on established stock year in, year out. So if you're buying property right and getting good deals with strong yields in growth corridors, you can consistently bank on that 7 to 8% growth. So it allows you to not only recycle the equity out to put it into the next deal, but you can also tap into 0.5%, 1% of that equity to fund your lifestyle, just like funding a business, using working capital in a business to fund the business. And you may be thinking, oh, am I going to get into more debt? Yes, that is the case. You are getting into more debt, but over time, inflation continues to inflate the value of the property, and that same property inflation of 7 to 8% continues to devalue the debt. Debt is currency. You need more of it to buy the same stock. You can see it when you go into the shopping centers. Blocks of cheese are selling for 17 bucks. Bottles of milk are selling for nearly 10, 12 bucks. Nothing changed. The 2-3 liter milk, the half kilo block of cheese hasn't changed. It's the same old cheese, same old milk. It's just the currency is getting devalued over time. And the beautiful thing with real estate is the value continues to increase and the debt continues to get eroded over time. So $1 million worth of debt today will be worth 150, 200,000 in 10, 15 years time. So it's irrelevant, the debt, provided you can balance the higher interest holding costs with the rental income, which also has growth over time, and you are conservative, or not conservative, but I would say you are responsible with your budgets and not overextending yourself. It is a very powerful way to use property, and you would find that 99% of the large property investors use the equity out of their portfolio to fund their lifestyle rather than the rental income, because if you're using the rental income, you'll get taxed. At today's rate, 45, 47% to the ATO is a lot more expensive than 5, 6% to a bank. So run your numbers, have a think about it. Very powerful way to use it. But established stock is by far the best stock to buy, as you can build in that equity from day one, have strong cash flows from day one and over time. And also you are minimizing the major building defects. These type of buildings have gone through the test of time. Solid double brick, typical structures, if it's either a house or a 2-bedroom unit or a 1-bedroom unit in a single story or 2-story walk up, if you're buying an individual unit or the whole block, this is the type of stock that we like to buy. Low maintenance, nothing sexy, nothing flash, fundamental housing that has gone through the test of time. So bricks last hundreds of years. Concrete, provided you're not buying right on the beach, will last 200 years. If you're going to get into boutique blocks right on the beach, the blue chip stuff that gets all the ocean salt, then it'll have concrete cancer. Not the best strategy, in my opinion. We like to stick into the suburbs, still close to the CBD, but more in the burbs. So solid building structures that have gone through the test of time. So you can't expect major building defects like buying into a new complex that could have major structural issues from day one from new builds, or even not getting your product delivered by a builder that's gone bust or a developer that has folded on a project. So we stick to established. It is the best type of asset to hold, especially in times with higher inflation. It's the best hedge against inflation because the asset soaks up that inflation. With higher inflation is actually good for property investors because it boosts the value of your property and it devalues the debt. you carry. So hope that helps. Hope that gives some clarity. If you want help buying established stock well under market value with strong yields of 6 to close to 8% in the current market, shoot us an email. I'll put my details in the comment below. As always, thanks for watching.